Fiscal year 2026 presented a chaotic environment for heavy commodity manufacturing. Global supply chains experienced violent swings that threatened to break standard unit economics. The raw material price shocks were severe. Ammonia spiked between $850 and $900 per ton, while sulfur hit $950 per ton. Across the board, vital input costs surged well beyond normalized historical ranges. Given those erratic input costs, profit margins should have collapsed. Instead, Chambal Fertilizers and Chemicals Limited managed a paradox. Their total EBITDA increased 8% to 2,679 crores, and their EBITDA margin actually expanded to 12.88%. They defended their balance sheet by activating three distinct structural and operational levers simultaneously, effectively neutralizing the external chaos. To understand how this was mathematically possible, we have to deconstruct the segment-level unit economics that insulate their cash flows. Survival in heavy commodity manufacturing relies entirely on structural engineering and operational mitigation. Historically, CFCL operated as an entity tied strictly to traditional agriculture. Performance was largely tethered to the volume and timing of the Indian monsoon. At the foundation of the company is the massive scale of their domestic urea manufacturing operations. Pure-play fertilizer producers operating under strict government regulations carry a unique vulnerability. When global raw material prices spike, they cannot simply raise prices on the consumer to absorb the cost. The financial performance delivered in FY26 represents a deliberate, engineered move towards structural resilience. The core financial friction of CFCL's urea segment stems from the Indian government's nutrient-based subsidy regime, which operates on a strict cost-plus model. In this model, the primary input constraint is natural gas, and CFCL faced an elevated price floor of over $18.50 per MMBTU throughout the quarter. The government compensates manufacturers for these elevated gas prices, but there is a structural lag. Manufacturing costs are incurred immediately, while the subsidy payout arrives months later. This timeline illustrates the resulting cash flow mismatch. High gas costs and lagging compensation create a massive gap, working capital bloat. The impact hits the balance sheet immediately. By year-end, CFCL's subsidy receivables spiked to 2,075 crores. Managing a shortfall of that magnitude required the company to take on elevated short-term borrowings to bridge the gap. In a regulated cost-plus system, delayed government subsidies act as a silent margin killer. A company must aggressively offset this drag through internal operations, or it will bleed capital. How does a manufacturer extract profit when the government strictly dictates the selling price of the final product? CFCL implemented a specific mitigation tactic, highly optimized plant turnaround schedules. During Q4, they executed a maintenance shutdown on only one plant, G1, rather than taking two offline. This reduced maintenance debits and temporarily spiked the EBITDA per ton. Next, they optimized against the government-mandated GCAL energy efficiency norms, which dictate the assumed energy cost required to produce a ton of urea. This Sankey diagram shows CFCL's operational outperformance. By running manufacturing units below government GCAL norms, every saved energy unit becomes a retained flow of direct margin. They also internally monetize a 3 to 5% ammonia surplus, capturing it as positive cash flow. Operational alpha in this sector is extracted by out-engineering the government's baseline energy assumptions. Beyond urea, CFCL's Chambal Fertilizer segment, producing DAP, TSP, and NPK, delivered a 175% revenue growth, hitting 7,025 crores for the year. The primary challenge for this specific segment in FY26 was strictly logistics, not production capacity. The supply chain faced severe shipping disruptions across the Red Sea and West Asia, creating massive friction points for global transport. This maritime risk collided directly with the supply chain realities of fertilizer imports, which are vital to maintaining regional inventory. CFCL countered this by executing an aggressive, early-cycle inventory front-loading strategy. They bought early, at scale. This arbitrage allowed them to secure adequate inventory coverage well ahead of the crucial Kharif planting season, bypassing the supply and pricing shocks that hit through July and August. This strategic placement intercepted a major consumer shift. Farmers are increasingly adopting balanced NPK and DAP fertilizers over standard urea, moving 12.31 lakh metric tons of volume. The margin expansion in complex fertilizers was achieved through masterful supply chain arbitrage, effectively sidestepping the Middle East transit disruptions. CFCL's ultimate structural defense involves diversifying its capital base into high-margin industrial sectors. The company has officially entered the commissioning phase of its new technical ammonium nitrate, or TAN plant, adding 240,000 metric tons of annual capacity. TAN targets a highly profitable, entirely unregulated market: industrial chemicals and mining explosives. Macro conditions strongly favor domestic producers. India currently faces a structural supply deficit in TAN. This domestic deficit is further exacerbated by geopolitical factors, specifically the strict export curbs imposed by Russia. Meanwhile, the underlying Indian explosive sector demands material to feed a steady 6 to 7% annual growth rate. CFCL enters this market with an immediate internal cost synergy. They supply the vital TAN feedstock, ammonia, directly from their own existing urea units. This process flow diagram maps the technical sequence. Utilizing state-of-the-art Casali technology, CFCL converts its raw feedstock into weak nitric acid. From there, the weak nitric acid advances into AN melt and finally crystallizes into high-density ammonium nitrate, ready for the industrial market. The TAN plant effectively insulates a new channel of future cash flows from both global spot market shocks and domestic government subsidy delays. Reviewing CFCL's complete model reveals a highly engineered capital allocation strategy. The foundational regulated cash generated from their high-efficiency urea plants actively funds the strategic inventory plays required in the complex fertilizer segment. This waterfall chart maps how the profits from those plays are then diverted to capitalize unregulated growth vectors, specifically the TAN plant and the IMACID joint venture. This model is also funding their next precision agriculture frontier, a biological joint venture with Nutrien, focusing on advanced nutrient use efficiency products. Looking ahead to FY27, their immediate capital obligations are controlled, requiring roughly 500 crores to finalize the TAN project and execute routine plant maintenance. CFCL operates a closed-loop system where heavily regulated agricultural margins are systematically funneled into higher-margin industrial growth. That controlled spending contrasts sharply with their future blueprint, a proposed 1.3 million-ton brownfield urea expansion that will require a capital injection of 9,500 to 10,000 crores. CFCL has secured the land and environmental clearances for this massive scale-up, primed to execute the moment the government releases its policy triggers. CFCL is an industrial powerhouse, re-engineering its operations to balance the volatility of the agricultural cycle with a resilient industrial core.